everyone. Welcome to the ABF Journal Podcast. I'm Rita Garwood, Editor-in-Chief of ABF Journal. Joining me on the podcast today is Matt Pencek. Matt, can you tell us a little bit about yourself?
Yeah, happy to be here. Thanks for having me. My name's Matt Pencek. I lead SolomonEdwards National Private Equity Services practice, where we really focus on serving private equity portfolio companies in areas of operational gaps that commonly stall growth across their investment lifecycle. Really happy to be here to talk through some of these really relevant issues that we're seeing across middle market private equity right now.
We're happy to have you. So, Matt, I was looking at your bio and it mentions that you specialize in helping companies navigate critical inflection points. So if you're looking back at your experience, it said you have over 1.3 billion in IPOs and 3 billion in M&A. What is the most common challenge that you see in middle market leaders face when they hit that high growth wall?
Yeah. Well, what I always tell our clients is that revenue typically scales linearly, and but operational complexity scales really exponentially when you hit those levels of revenue. And most middle market CEOs, CFOs are operators first and not integrators many times of add-on M&A. So when your growth is coming from a lot of inorganic growth, uh, that operational complexity explodes. And without having kind of a structured approach to integration to tackle that growth and to scale things like having a right ERP system, having your reporting nailed down, HR systems that can take on multiple um, add-on acquisitions with people to absorb all those acquisitions without that structure can be somewhat degrading to the core business at times.
So you've held roles from founder to managing partner. How has your perspective on value creation changed from the early days of your career to the current interest rate environment that we're seeing in 2026?
Yeah, well, it's surprisingly changed a lot over the last, call it 16, 17 years, where, in the early days of my career, I would say value creation in the private equity space really came from revenue growth and multiple expansion. We had low interest rate environment, and that kind of rising tide lifted all boats, so to speak. So you could kind of paper over those integration failures of add-on acquisitions, usually with some cheap debt and relying on that multiple expansion. Now, as more and more capital has been pumped a lot into the middle market private equity space, and then the interest rate environment has changed, with base rates still meaningfully higher than those pre-pandemic levels. You really can't financially engineer your way through returns anymore, and every basis point of that EBITDA margin really matters. So nowadays, I kind of tell our private equity sponsors that we work with that, this kind of buy, bolt on, and flip playbook that has traditionally worked and relied on multiple expansion and cheap debt, it only works nowadays if those bolt-on acquisitions are actually integrated. Otherwise, you're kind of just adding more complexity and overhead um, in an environment where higher rates, tighter multiples, and margin improvement and cash conversion are kind of the new value creation currency. You really need to be prepared with a tighter operating model that is, tightly interwoven with your integration strategy.
So, in the call we had to plan this podcast, you used a term that I found really striking. It was zombie buildup companies. For the benefit of everyone listening to this, could you explain what a zombie buildup is and why it's becoming such a prevalent issue for PE firms that are reaching the end of their hold periods?
Yeah, absolutely. I don't know if I coined the term or if I heard somebody say it and I kind of picked it up along the way, but it really resonates with me because so many times we get calls from private equity groups that are looking, 12, 18 months into the future around, hey, I want to exit this business, but what are the things that we need to do to prep? And we kind of get in there and we realize, oh wow, this is a bunch of bolted on acquisitions together. And what is how are you going to pitch this thing? And so I kind of refer to a zombie buildup as a private equity backed platform that has made those multiple acquisitions along the way, but really never truly integrated them. So on an org chart or in some type of marketing material, they might look like one company, but they're operating really as three or four or five or 10 different businesses with different siloed systems, P&Ls, and even cultures. So, they're alive from the sense of still generating revenue, but kind of dead and zombie like in the sense that they really can't demonstrate the synergies of unified reporting and scalable infrastructure that either a strategic buyer or a new private equity sponsor is going to want to see in underwriting that premium valuation that these private equity sponsors are looking for. Um, and so, it becomes an issue when you're starting to prep for exit because they're saying, why can't I, I'm prepping to take this thing to market and the early signs of valuation aren't coming into what I really expected when I wanted to take on this investment thesis. And so it just becomes even more important for those companies that are taking on those types of strategies today. And maybe it's an exit horizon in 2, 3, 4 years to really have that front and center in their mind as to how they integrate these add-on acquisitions into the platform so that they can command that multiple premium at exit and achieve the types of returns that they're looking for and have promised to their LPs.
So, when you talk about giving that love and attention to the integration process, what specific back office or procurement wins should firms be targeting for the first 100 days?
Absolutely. I love this question because when we talk about that first 100 days, that's the execution stage. The preparation for that first 100 days starts during deal execution prior to day one. And that means in planning for the integration during diligence, figuring out, hey, what were those findings that we had in diligence that might make us think about the way that we integrate our systems, our people, how we combine these two entities into one. Um, and then if you've got that plan ahead of kind of all the wires being sent at closing, then you can hit day one with some of these, what I call quick wins. And those quick wins come in the form of, like, I would say two main buckets. One is all your back office stuff. What are those things that you can do in your back office to get, you know, meaningful returns or improvements early on? And then the second bucket is in kind of more procurement and cost savings. So in the back office bucket, I would say looking at things like, hey, do we need to be on one single payroll provider? We could get immediate visibility into our payroll costs if they're all in one place at one time. The unifying things like AP and cash management, getting on the same bank accounts. Uh, Consolidating into a single chart of accounts, maybe benefiting, your benefits. Can you get them into one standard, harmonized, structured plan? So those are what I would call kind of our quick wins in the back office. And then on the procurement side and cost saving side, I would say, like, take a look at, if this is an add-on acquisition, take a look at the top 10 vendor contracts between the two entities and say, hey, do we have some type of shared spend here that we could in our combined scale can really drive some pricing uh, uh, benefit and negotiate with our vendors to get better pricing with them. That comes along all with all types of vendors, including things like your insurance policy, like D&O, workman's comp saving policies. And then this is a big one that I see is around your technology architecture. There's going to be most likely duplicate, redundant technology spend across the two entities. How do you come up with a efficient, structured plan to come onto one tech stack to make sure that all of your reporting that you want to be able to provide to your private equity sponsor is able to be done efficiently, but not with some over bloated tech stack. So I often tell clients, like in that first 100 days after an add-on acquisition, that it should be about really the cash visibility and like looking at your cost baseline, because what you can't measure, you can't manage. And so if you can get those systems and processes and in place shortly after close, then you can measure it and manage it the way that you want to in line with your investment thesis of why you did the deal in the first place.
Makes sense. So lenders often call you when they suspect a liquidity crunch is happening. How can a lender tell if a portfolio company is suffering from a temporary working capital lag or an underlying failure to integrate its acquisitions?
Got it. So, yeah, this is a big one because we will get calls from lenders and say, can you work with this company to figure out whether this is an underlying business issue, or is this something that, through the progress of time, we're going to get through some one-time non-recurring event. And so I would encourage lenders to take a look under the hood to say, hey, is this a one-time DSO spike that is happening, that, or that's probably due to something like a system migration or some type of seasonal inventory build, or maybe a large customer that's paying really late, that's going to resolve itself in a quarter, and that can be explained with clear data? Or is there something more to this that is pointing towards some type of failed integration? And that usually, the symptoms you see in that are usually there's a creep in DSO that is persistent, and there's no real clear cause, and the portco can't tell you why. You might see margin compression across the acquired entity that just came into the fold, or they're not able to produce segment level P&Ls that would allow you to even see that. And then you might even see them drawing on the revolver, quarter over quarter without much in terms of revenue ramp to kind of offset your concerns there. So I kind of challenge lenders in this, and I say, here's a little bit of a test. If you can ask that management team to provide a entity by entity cash flow bridge for you, and if they can't produce it within, call it 48 hours, usually that's pointing towards something that the businesses really are integrating at the reporting level. And reporting, I say, is kind of the minimum level of integration. So that should throw your flags up a bit and say, hey, like, are there excess integration costs here that weren't really captured or estimated on the onset that need to be really taken into consideration? Um, I often say that too, with kind of looking at like, hey, what's my downside when as a lender when taking at these integration costs? Usually there is some type of cash flow conversion rate issue. So a lender might be sending you those lender financials on a monthly, quarterly basis with a compliance cert, and there's an adjusted EBITDA in there that might line up to what your and be fine in terms of covenant compliance. But when you start digging one layer down into some of the adjustments, though that are true cash out the door, the EBITDA to free cash flow conversion rate is off. And that provides big issues at the portfolio company level on liquidity and being able to fund their operating expenses. Um, so I often say to lenders, work with your portfolio companies to truly understand that EBITDA to free cash flow conversion so that you can really uh, you know get understand the risk profile and whether a liquidity constraint because of integration is due to something that's more one time in nature versus a systematic issue at the portfolio company.
Well, thanks so much, Matt, for joining us today and for going through all of this. I appreciate you taking the time.
Yeah, absolutely. Happy to do so.